volume and P for profit, right? Volume means units production. Units production quantity, yes. Quantity. So it means units production or quantity, volume, right? So we all know that when we produce something, with the change of the volume, with the change of the unit, with the variation in production, with the increase or decrease in quantity, our cost and profit also changes, right? Our cost and profits also changes. So there is a very strong relationship between cost, volume, and profit. So we need to understand that what is this relationship and how should we understand this relationship, right? So the first thing is we try to follow marginal costing. Marginal costing. So in accounting, marginal costing is a very interesting concept. And this concept talks about variable costing. So we also called it variable costing because our main focus is on variable costing, not on the fixed costing, right? And we less variable cost. Then we are left with contribution margin. Contribution margin, right? Then further, we also subtract fixed cost. And we are left with operating profit. Operating profit, right? Now you guys may be wondering that what is fixed cost and what is variable cost. This is new concept for you. Now variable means it is changing, not constant, variable. And fixed means fixed, it is not changing. So in any business setup, we have two types of cost. One is what we call variable cost, and other one we call fixed cost, right? Okay. So what is the difference between variable cost and fixed cost? The simple difference is variable cost changes with the increase in unit production. I mean, if I take volume here, so with every increase, with increase of every single unit, variable cost will change, but the fixed cost will not change, right? So we need to understand that we need to consider two types of variable cost. One is called per unit variable cost, and other one is called total variable cost, right? VC stands for Vice Chancellor. No, variable cost. VC stands for variable cost, yes. Then we have to find out per unit fixed cost. FC stands for fixed cost, and total FC stands for total fixed cost. And then we have TC, total cost. Is this clear? VC stands for variable cost, brother. FC stands for fixed cost, and TC stands for total cost. Is this clear? Okay. So let us assume we are running a business. And if we produce one unit, if we produce one single unit, our per unit variable cost, let's suppose $3. So total variable cost, we find how much, how can we find total variable cost? We multiply this per unit with the unit. That is how we find total. Okay. Now we produce 2, and our variable cost per unit is 3. That remains same, but our total will be 6. If you produce 3, our per unit will remain same, but our total will be how much? 9. Right, sir? So can I do this? Can I ask Excel to please proceed with 10 units? And you know, for every single unit, the variable unit cost remains same. And that is how much? But the total variable cost will be different. So you might be noticing your variable cost remains same, but your total variable cost is increasing. Very simple, right? So believe that per unit variable cost remains same, but total variable cost increases. Per unit variable cost remains same. With every single unit, variable cost per unit, it remains same, but total variable cost is increasing. Simple, no difficulty. Okay. So if you talk about total fixed cost always remains same. So let's suppose you are doing business in a rental building and the rent of the building is 4,000 per month. So whether you produce single unit, whether you produce 10 unit, whether you produce nothing, you have to pay the rent, which is 4,000. But if you produce one single unit, the per unit fixed cost will be like this. It means with every increase in unit, your fixed cost is decreasing. If you produce 1 unit, your per unit fixed cost is 4,000. If you produce 2 units, your per unit fixed cost is 2,000. And if you produce 10 units, your per unit fixed cost is 400. Yeah, divide.
Depend on production. It depends on production.
Per unit. Per unit fixed cost depends on the production. So we can say that per unit variable cost remains constant, but total fixed cost remains constant. And total variable cost keeps increasing, and per unit fixed cost keeps decreasing. Okay, now how do we find the total cost? It is the sum of total fixed cost and total variable cost. We add total fixed cost and total variable cost. Right? Okay. Right. So can I say here that total variable cost is equal to per unit variable cost, per unit variable, sorry, total variable cost is equal to per unit variable cost multiplied by units. Can I say this? Any problem? No. Can I say this? Per unit fixed cost is equal to total fixed cost divided by units. Can I say this total cost is equal to total fixed cost plus total variable cost? Can I say this per unit variable cost always remains same and total fixed cost always remains same? Right there? Okay. Now we are making graph. And how do we do that? We go to insert. And here we have a chart, scatter plot, where we can study the relationship because there is a relationship. So we will select this one and you can see a very beautiful graph. Now just have a look at this. This line, this one is your total fixed cost, right? If I select it, it will be get highlighted total. And you can see it is continuously increasing.
Can you explain why values when it means? Can you explain what is?
Sorry?
What is you said before when I clicked it?
Yeah, I like explain it again. So we are discussing the behavior of the cost. We have different costs, right? Because when we run an organization, we have variable cost. VC stands for variable cost. VC stands for variable cost. VC is equal to variable cost, right? And FC is the fixed cost. Fixed cost that remains fixed and variable always changes. So we have two type of variable cost, brother. One is called per unit variable cost, and the other one is called total variable cost. So per unit variable cost always remains same per unit variable. If you produce 1 unit, it will be same. If you produce 2 units, for every single unit, it will be same. But when we talk about total variable cost, it will increase with the increase in units. So we understand the behavior of per unit variable cost, which remains same, but total variable cost, it always increasing. Then we have total fixed cost. Let's suppose in this scenario, the total fixed cost is $4,000. So whatever unit you produce, it remains $4,000. But when we talk about per unit fixed cost, it decreases with the production. If you produce nothing, still you have to pay 4,000. But it's better to produce more unit because per unit fixed cost will be lower. And finally, we found the total cost. Total cost is the sum of total fixed cost and total variable cost, right? So all the formulas are written here. And again, brother Emmanuel, what you're writing? I'll send you everything. Just watch and reflect. Nothing to worry about, right? Just sit like a director of the company and I'm presenting in front of you, right? So, brother Amir, just have a look at this graph, right? Now, this line, this is known as total cost. So it is always increasing. This yellow is total fixed cost. And how many units produced, it doesn't make any difference. It will be always constant. This red line is the total variable cost and it increases with the increase of volume. This yellow straight line is per unit variable cost. And if you see this declining graph, it is per unit fixed cost. Right? Okay. So if you don't mind, can I ask you something? Okay, I asked from Brother Rizwan, this yellow line, this is which cost? Per unit fixed cost or total fixed cost? Per unit fixed cost or total cost? This is total fixed cost. Absolutely. Kanyappa?
Yes.
Brother, this red line, this is total variable cost or per unit variable cost? Total variable. Brother Emmanuel, I know your heart is beating fast. Brother Emmanuel, this graph, which is declining, is it total fixed cost or per unit fixed cost? Per unit fixed cost. Can I ask you, sir?
Yes.
Okay. Rather this one. Total cost. Okay, can I ask something? Why this total cost graph is starting from 4,000? Why this graph is starting from 4,000? Who can answer? Total cost. Total cost. Why it is starting from 4,000?
Fixed cost is 4,000.
Yeah, because the fixed cost is 4,000. People with name are always intelligent. So whether you produce something or nothing, it will always cost you 4,000. That is why it is starting from here. Right. Thank you so much. Now, brother and sisters, come back to this question, right? So let's suppose here I will write units, and here I will write per unit dollar, and here I will write total dollar, right? Okay, right? So sales, assume we produce 10,000 units. How many units?
1,000.
10. And the per unit selling price is, let's say, $10. So what is the total sale? 10 multiplied by? Wow. No problem. Now variable cost. Assume per unit variable cost is $6. So total variable cost will be how much?
0.
So your contribution margin will be 100,000 minus 60,000. It comes out to 40. This is your contribution margin. Contribution margin. Sales minus variable cost. And then you subtract your fixed cost. So assume the fixed cost is any value. Assume 15,000. Okay. So your operating profit will be 40,000 minus this is 25. Okay. Any problem? No. Sales minus variable cost. This is called marginal costing. We call it marginal costing. Okay, sir. I will provide you the print after this session. So don't need to worry, right? That's why I'm copying everything over there. You just pay focus on the whiteboard, nothing to write. You are for demo class, huh?
Yes.
And you are confirm or demo class? Confirm. So far, demo is going good. Huh?
Yes.
Look at into my eyes. Say yes, sir.
Yes.
Okay, sir. Now the next thing is, which is very, very interesting. Now we are going into decision making. Emmanuel, hold your number. Now we are going into decision making. And a very important decision we are going to make, decision making. And that decision is how many units we need to sell for breakeven. Do you know what is breakeven? Breakeven is a point where you have no profit, no loss. Break even is the point where you have no profit, no loss. So we need to find this point. So we need to make a decision. Why we are making this decision, Brother Emmanuel? Why we need to find out this break-even point? So that we should know that how many units we need to sell to reach the break-even. At least we should understand what is the break-even point, so that the point at where we are not profit numbers. So the formula for this break-even is very, very simple. You will enjoy this one. The formula is, I'm writing the formula of the break-even. So go to equation. One of the easiest formula you will always remember. Now you tell me one thing. Which cost we need to cover to get to the break-even? Fixed cost or variable cost?
Both.
At least which cost we should cover?
Variables.
Fixed.
Fixed.
Are you married? Your family is here or in India?
India.
India. When you bring your family here, what is the first thing you think about? What is the first cost you think about? Why you are thinking about rent? Why you are not thinking about grocery and everything? Huh? So the first thing you think about is rent. And let's suppose if you are successfully capable of paying your rent, you will bring your family definitely, because you can pay your fixed cost. So brother, the formula is fixed cost divided by contribution per unit. This is the formula. Very simple. Very simple. If we cover our fixed cost, we are at breakeven. Fixed cost divided by contribution per unit. Now we have two variables. The first variable is fixed cost, which is definitely given in the question. Fixed cost is here we have, right? Am I right or wrong? So you have the fixed cost, you have not to worry about it. You have this fixed cost. So the only thing you need to find is contribution per unit. And please tell me one thing. Do you have this contribution margin? Yes, you have this contribution, right? So this is your total contribution. So if you divide this contribution by number of units, you will have contribution margin. Contribution per unit, right? So what is your contribution per unit? If I write is contribution per unit, yeah, either you can write contribution margin per unit. CMPU. CMPU stands for contribution margin per unit, right? Okay, so the formula will be total contribution divided by number of units, and that is how much? That is $4 per unit. Now, dear brothers and sisters, if you divide your fixed cost by your contribution margin, this is your break-even units. Take deep breaths. Take breaths from your mouth, from your nose, and exhale from your mouth. Okay, it means, brother Emmanuel, if we are capable of selling 3,750 units, we are ready to break. Nothing to worry about. Okay, now we can cross check it. We can cross it. Just take all the values from here, copy and paste here. And you can cross check. How many units we are going to produce? For break-even. 3,750, right? And again, how many units? 3,750. What is operating profit? No profit, no loss. So if you produce anything more than this unit, you will be in the profit. Now, after this 3,750, every single unit will give you profit. Every single unit will give you profit.